We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Bob Coleman from Idaho Armored Vaults. Bob, thanks for joining me today.
Hi, Tom. How you doing?
Excellent. Always good to have you back, Bob. And of course, we're speaking today, January 20th, the day of Trump's inauguration. There's lots to go through. Markets are closed. However, there's been some interesting developments. And part of what I wanted to talk to you about today is these EFP premiums, or the exchange for physical premiums, right now kind of really blowing out over the last couple months here. So I want to really go through this process as you've been noting it on your Twitter, why this is so significant, and if this all really kind of was sparked by the worries of the tariffs that Trump has been talking so much about.
Yeah, you almost have to go back to his campaign and look at the sort of the rhetoric that he was talking about then in terms of trade policy and so forth. And then obviously as the election kind of came to fruition and he kind of continued that rhetoric of going after for fair trade, implementing these across the board tariffs for Canada and Mexico and Australia and China. And I mean, these are all countries. What started to resonate, and I picked up on this very quickly. And I think in early December 5th, I put out a post on Twitter that really resonated and explained this entire process, actually what it would mean for the gold and silver market. What actually ended up happening is about a week later, it started to filter actually into the gold and silver market industry. And so how this kind of takes life, I guess you could say, is that in the industry, you have what they call the futures markets in New York, and you have where most of the trades are done on the physical level. They're done more on the London side. So you have the London spot market, which is the physical markets, the New York futures markets, which tend to gravitate the trades and the hedging strategies and so forth, that industry will actually sell on the New York market and they'll buy on the London market, because when you're dealing with futures markets, you have this time value of money and you're dealing with a futures price, meaning say 2 months out or 3 months out. So that price will be a little bit higher than actual spot price. And so that the way the industry works is you sell whatever the lead month contract is. And then back in December for February, or for gold, it was February's contract. For silver, it was March contract. So you had this natural spread between the spot price and the futures price. And typically, as you get closer and closer to the delivery month itself, that futures price and the spot price kind of come toward parity. They kind of come together, and that's just because you have a time decay of money. That time is becoming shorter and shorter, and the cost of carry is becoming lower and lower. Well, what happens with the exchange for physical trade, and it's really a spread trade. It's not really a process. What was happening in December was, with tariffs, if you start to implement tariffs into this equation, typically when that exchange for physical trade kind of takes place, you're really dealing with two different locations at the same time. And typically the way to close out your short position is you either buy it back or you deliver metal that you may put on the exchange and use that as your settlement against your futures, against your short. Well, what started happening was when President Trump was talking about tariffs, he was naming countries that were very big exporters of gold and silver to the U.S. And with the COMEX, you're talking about 145 different hallmarks. 47 of these hallmarks actually were potential countries that had or the potential refiners that were located in these countries that started to say, okay, this could be supply that I'm sitting on in London that may be good delivery in New York, but it may have a hallmark from Mexico or a hallmark from Canada. Even though I'm shipping it from London, the product of origin was one of these countries that potentially could have a tariff slapped on it. So basically, when you bring in that amount of metal into the U.S. and it has a tariff associated with it, now you're dealing with a cost of whatever that tariff is on top of your typical transportation and that type of thing. And when you start to,
sorry, Bob, to interrupt, but I found that very interesting. That even if it's already in London, if it comes to the U.S. from London, and it was made in Mexico or let's say Canada or wherever that might have a tariff associated with it, they look at the country of origin, not the country where it's being shipped from, right?
Yeah. They technically they call it product of origin. But yeah, you're right. It's an interesting thing when you're importing metal into the U.S. And I was doing that with clients back in 2022. I believe it was, we were bringing products from Singapore and Hong Kong over, and one of the products happened to be, I think it was silver bars. It happened to have a product of origin, or happened to have a Chinese hallmark, and it was a good delivery refiner, well-known refiner out of China. It was a LBMA and COMEX good delivery hallmark. But when you started to look at the tariff codes and so forth, the harmonized codes, it popped up as a tariff on refined gold and silver coming from China. And when you, for people that may not be logistics in terms of moving metals into the U.S., when you do basically you declare the asset coming into the U.S., you have to declare, okay, who the hallmark is and where that hallmark originated from. There's no way of getting around the tariff because it's potentially can be inspected, and there's more risk in falsifying a declaration. And so this is where it got interesting, because the CME, when I was doing all this research in 2022. I contacted the CME and talked to 2 or 3 different departments, and they finally got to the right department, and they didn't realize that the Chinese hallmarked bars that were named good delivery bars into the COMEX actually had tariffs associated with them, which actually didn't make any sense from a standpoint of even doing if someone was shorting a contract expecting to deliver these products to the exchange. Economically, they didn't make any sense. And so now you have potentially 47 of the 147 bars out there that were good delivery bars that now could be susceptible to these tariffs if all these countries, kind of day one, he comes into office and says, okay, I'm going to do full tariffs across the board to try and gain some leverage. It changes the equation. And all of a sudden, in December, it got a little tight. And then it kind of calmed down at the end of the year because of some book squaring, and trading kind of lightened up, just your typical holiday trading. But then it flared up again in January as you're getting closer to the February delivery month for the gold market. And that actually started the flare up again, because you were talking about a delivery month that was very, less than a month away. And then that started to actually also impact silver as well. And you started to see these premiums blow out or widen again when they should be contracting. And this is where participants in this market, you're dealing about a heavily levered trade here that is really designed to bridge the paper world and the physical world together. And when you have, you're talking 400 million ounces, for example, and every 10 cents, you're talking about a $45 million potential loss if it's going in the wrong direction. So you're talking about some major numbers here. And that's what was happening last week, for example, when the spreads really blew out again. You were seeing players, from what I was reading, they were just getting wiped out. They were covering their shorts. They were getting out of the EFP trade altogether. Banks were tightening up lending, making it more expensive. Leasing rates were going up, and so it was hampering the entire industry. And so people are looking for some sort of direction on these tariffs. Sometimes these things feed on itself, and it creates its own energy. And until maybe there's clarity or something spoken that cools the market down, that process just keeps going until it hits some sort of some sort of pressure cooker. Typically, the price is sort of the release valve for all this pressure. Typically, and I showed a chart on my Twitter or X feed about the long-term, a 50-year chart on the sort of approximation of the EFP. It was a chart that took the futures markets and the cash market, and the difference between the two. It was a continuous contract on the futures markets minus the spot price, and it went back 50 years. And okay, there you go. And it shows that typically when you get these blowouts in spreads, the price tends to actually spike as well. And we haven't seen the spike yet in price, which I thought was interesting. I mean, it's been an odd environment where this EFP situation has lasted as long as it has. But it hasn't resolved itself, I guess, is the big thing. So, you have a lot of people over the weekend and late last week saying, "Oh, this is nothing; it'll just blow over. It's nothing to worry about. The price is just going to get smashed back down, just like the typical banking cartel and the smash on the COMEX, and everything is going to be sort of manipulated downward." But what I'm seeing is something the exact opposite. Until you get some sort of clarity, what's happening is liquidity in the gold and silver industry is tightening up. It's acting much different than it normally would. And that's where you have to respect that type of situation.
Well, Bob, that's really important I think we need to distinguish here between what's going on with the EFP and why these banks are needing to source this metal to cover these shorts, and separate that from the retail side, which is worth understanding as well. So let's just, walk through again why there's higher demand on the physical side from these institutions at this point, or up until last week.
Yeah, right now, what people may not understand is when you have the threat of tariffs in the U.S. on physical precious metals, it has a reactive situation where initially the U.S. is a very dominated market when it comes to derivatives and the futures markets. It's the center of hedging activity tends to be New York, and so New York is a seller's market, so to speak. Mm-hmm. And it's not nefarious. I mean, it may be mining companies that are hedging their production. It could be banks that bought metal in London that they're using the New York markets to hedge that price, so they have price neutrality. So they may not take, they may protect their profits, so to speak, or guard against unwanted price movements, that type of thing. But what happens is you're short in New York, meaning you're borrowing something that you may not have, or if you do have it, it's over in London. So you have to, if you ever called on that, you have to basically move this product all the way from London to New York. And most of the time, this EFP, it has this natural premium associated with it, and as you get closer to the expiration of the futures contract, that typically goes, that spot and the futures price basically come to parity, and that's what that green box basically represents in that chart. That's parity. That's basically the zero line where both the futures and the spot price kind of meet, and that's where most of the time it takes on account. Since 2020, you had some interesting scenarios come into play where in March of 2020, April 2020, you had that EFP blowout, and part of that was due to sort of the volatility in March, and also in the markets, but also the logistics limitations of moving metal from London to New York initially, and forcing a lot of banks back then to cover their shorts because they couldn't get that metal over to New York to cover their short position. And I think HSBC had lost like $75 million that one day alone. Well, and then, of course, in 2022, you had what they called backwardation when we were at near zero interest rates, and the futures markets were selling off, and all of a sudden the futures price was actually less than the spot price, and that typically tends to tell you that there is demand for the physical metal more so than the paper price. Well, now you're back into another situation where now the futures price is going up on an accelerated fashion higher than the actual paper price, and that's due to this tariff issue where now people are nervous about their short position and they're trying to get metal over to New York to close out that short position because maybe liquidity has dried up and making it more difficult just to simply say, I want to just buy my short position out and I'm done with the trade. The problem is it's pushing that price higher and higher and creating losses for those who aren't supposedly that are still short the market. And so the easy way to do it is you deliver your metal. It's sort of a net wash because you were short the market on the futures. You actually had the metal in hand, and you're just giving the metal over to cover that short position. Mm-hmm. And that's why you had this big rush of metal coming into New York, is that people are trying to use metal to either close out the short position, or you have traders that are trying to take advantage of this arbitrage spread and this very unusually wide EFP. And they're saying, hey, listen, I can move metal over from London or wherever it may be into New York, and I can short and make money on that spread, which is artificially high at the moment. And so you have people that are potentially shorting the markets and trying to deliver metal, and all of a sudden the EFP starts going even higher, and all of a sudden those guys that are short, which we're expecting to trade, are now getting blown out. So the thing tends to feed on itself. Eventually, if the price goes up enough, and maybe the arbitrage takes care of itself, things start to settle back down. But until you have, that's natural pricing arbitrage. The problem is we just don't know what these tariffs are, because if the tariff comes in at 20%, all of a sudden the cost to bring that metal into the United States is 20% higher, and now metal that's existing in the U.S. is becoming harder to get because it's obviously a lot cheaper than trying to bring potentially tariff-oriented metal into the country.
Mm-hmm. So, according to this chart, Bob, the last time that we really saw the EFP premiums this high was in March of 2020. So is this the same type of scenario that we did see, basically at the start of COVID and the issues surrounding that?
Yeah, the COVID thing was more about the reaction to lockdowns and that type of thing.
And really supply chains, right?
Yeah, supply chains, and it had to deal more with, you have to remember they cut financing or interest rates to near zero. They flooded the system with money and so forth. So a lot of this had these tertiary consequences. But if you notice, typically the price reacts with these EFP contracts. When you get to these unusual circumstances, price does have some type of follow through. And when the EFP kind of blew out, that actually signaled a very strong move for gold and silver going into, I think it was early August, late July. It was sort of a signal, so to speak. And that's where I'm watching this markets now, and I'm saying, okay, going back 50 years, and you look at when these EFP spikes, these tend to be, not just simply a one and done, an overnight type of move, and you get a spike in the price of metal, and then everything kind of crashes back down. This tends to be something that is a little bit more long lasting, that actually can be something that feeds on itself over a period of months, not necessarily just a couple days. And that's where I try to help educate people, staying away from the idea that this is, the banker cartel doing this and they're just going to smash the price back down and suppress the price. This is something that's more actually affecting the industry. It's affecting the banks that have shorted, that create their market makers in the EFP. It's affecting market makers themselves, authorized participants who interact with the ETFs. These authorized participants use the futures markets to hedge their physical inventory that they actually use to move into and out of the ETFs as they create and redeem shares. I mean, this affects the industry on a much wider scale than I think the retail actually understands.
Mm-hmm. Well, that was the other side of what I wanted to ask you, Bob, is like, you and I were talking before we started recording today about this, this really lack of appetite within the retail market. Gold is, let's say, within 10% of its all-time high right now. And yet sentiment is still overall quite low. There's a lot of physical selling coming back in. So how does that affect this actual, let's say, retail side of things?
Yeah, it's one of those things where I think you still see buying coming in from the individual or high net worth individual. I think they're still allocating into the metals themselves, but the smaller retail investor, that was piling into the markets in 2020 through 2023, they've certainly walked away. You've had people, you got to remember, I mean, the physical gold and silver markets really started to take off in early 2000 or the mid 2000s before the 2008 financial crisis. And then when the 2008 financial crisis came to be, that inspired a lot more buying of gold and silver back then. So, crescending into 2011, you had a lot of people buying physical metal back then. So fast forward another 15 years later or so, there's a lot of overhead supply that, people are gotten older, their lifestyle has changed. They want income instead of, trying to gain the potential capital appreciation that the metals may provide. And so you have this sort of life change moment, or people that are just passing away and giving it to their heirs, and the heirs not understanding why grandpa bought all these silver coins. They're just going to go ahead and sell them and buy whatever they want with them. And so you have this sort of almost not maybe a not distrust of the market, but almost a lack of understanding of what the metals sort of represent. And in 2020 to 2023, I think the industry did itself a major disservice by overcharging people on the premiums, creating some of these crazy stories to try and drive sales, to move inventory, to get as much premium they could from the consumer or out of the consumer. And I think people started to sell back as the prices rose, and they say, listen, I'm not making any money on this because I bought silver at 25. I spent $6 to get into this thing. It's at 32, and now they're going to bid me $2 or $3 or $4 under spot to buy it back. And so there's that has brought in a really foul taste to physical metals investors, I guess. Their outlook and as an asset to protect their purchasing power. And I've talked to a lot of people, and they're like, the only person I protected, their purchasing power was the dealer who sold me the metal. They pocketed fairly handsomely, and that's something that the industry really needs to change. Unfortunately, we live in an environment where the industry itself is completely unregulated, so there's no pressure on them to actually want to change. And so now you see a lot of these online dealers and retail dealers out there bidding $2, $3, $4 under spot for silver. They're bidding $100 to $150 under spot for gold products. And people are seeing this, and they're like, this was never told to me when I bought it, the risks of all these spreads and so forth. And I think this is really starting to bite on the retail side. And that's unfortunate because we're at a point in time right now where the metals have never looked better from a story setup and also a structural setup. Yet the retail is it's almost as if the market's climbing this wall of worry, but it's shaking sort of the retail off the trail as it starts to march higher. And that's what I've been trying to help clients that even have bought metals that are just holding the physical product, just try to help educate them to say, listen, this is the landscape we're in right now. This is what's actually going on. And you're seeing the pressure from now the industry having to deal with the highly leveraged finance game that they play with the precious metals markets, that leverage and hedging strategies that actually have actually held the price in check for so long, that is now starting to break if tariffs are implemented, and that has a whole new meaning to the world of precious metals. You may not have that cap or that selling pressure that you traditionally have had from the commercials and from swap dealers and from producers and so forth. You may see a market that actually the physical becomes a more price dominant theme.
So, Bob, is there a big difference between the gold and the silver market right now in relation or in regards to this EFP?
Both of them are very elevated. They've come back down today as we talking. This is Martin Luther King Day, and it's a holiday in the U.S. markets. Even though London was open, you saw the London spot price go up. And I think the futures price, I think from last night, I think went down a little bit. So the spread that EFP has shrunken, and of course we'll know a little bit more tomorrow or tonight as the futures markets reopen and react to whatever President Trump is saying and sort of other types of events that are going on around the world and how other investors around the world are reacting to that. But that's. I would expect that the EFP going into the February gold delivery month, by the last day of January, which is really first notice, I would expect that spread to contract. But it may be that the spot price lifts higher. It may not be the futures price that comes down, or it could be a combination, obviously. But that's something that's a short-term event. That's just short-term volatility. You want to, as a physical investor, or retail investor, high net worth investor, you're looking at, okay, what's it going to look like, 6 months down the road, or 3 months down the road. This is all great news to hear in the short term, but what does it mean longer term? And that's obviously, this is where uncertainty kind of sets in, because you're dealing with a new presidential administration, new policy. There's obviously he has an agenda, and he wants to get across, and make deals that are that he feels is good for the United States, and that may be a lot different than what obviously the prior administration was doing. And so you're trying to figure out, okay, what are these deals? How are they going to affect the markets? And when you're dealing with gold and silver, even though silver is an industrial commodity, at the end of the day, they're still viewed as money or monetary instruments. And so tariffs have a bigger impact on these monetary instruments than, for example, potentially just physical or industry demand. One important note, though, too, also when you're dealing with the United States and you're dealing with gold and silver, with silver, for example, most of the silver demand, the industrial demand side, is actually met with the importation of silver from other countries. You're talking, I think it's like 300 million ounces that are actually imported into the country to actually satisfy industry demand. That's where these tariffs start to play a bigger impact, and this is the storyline that has a broader appeal that I've been trying to explain in posts going back to December. And this is, I think, where the banking industry is starting to realize, and just the industry, the fabrication industry and so forth, they're starting to say, listen, we may need to shore up some supply and do it quickly. And that's where this whole thing is continually kind of snowballed and tightened.
Mm-hmm. Bob, is it possible that this also extends into the platinum market?
Yeah, platinum is another strategic metal that actually most of it comes from outside the country. And it's one of those things that it doesn't catch fire until it does. I mean, it may not be on people's radar right now because they're thinking, okay, we had electric vehicles, we had this green energy push and so forth, and you're not going to have the need for catalytic converters. And obviously on the hydrogen market side, platinum is very crucial to that energy demand, and how hydrogen technology works in a sense of using that to generate the power to drive vehicles or larger transportation devices such as ships or buses and things like that. That takes maybe some time, but the platinum story is interesting because you're still having supply constraints, I think, trying to pull more metal out of the ground. So if you really had a rush of demand or a worry that, for example, all of a sudden maybe we're not going to, platinum is not necessarily a monetary metal, but if gold and silver continue to rise, and gold relative to platinum is extremely expensive. In fact, it's probably the most expensive it's ever been in the history of those two metals relative to each other.
Mm-hmm.
You may see investors saying, listen, platinum is cheap. Why don't I start moving some money out of gold and buying platinum? And if you start to see that shift, it would not take a lot to absorb a lot of the excess platinum that may be on the market right now. And you could see the platinum market, which is very tiny, it's much smaller than the silver market, could really be affected to the upside.
Mm-hmm. Is that something that you typically look at for the fund that you run? Is looking to the gold and silver ratio, or even the gold to platinum ratio, as you just mentioned?
Yeah, just for full, I guess, disclosure, I do run a hedge fund. It's about 100 million in size. It focuses just strictly on physical metal. The current allocation right now is about 26% or so, 27% gold, 73% silver, roughly, and it's all physical metal stored at our vault here in Idaho. It does look at gold silver ratio. Like I've really overweighted to silver, expecting I think this year is going to be a big year for silver. I think typically gold tends to lead the charge a lot of the times, but then the white metals sort of follow suit. They kind of catch that bid as the market broadens, and you tend to see that overperformance of the white metals. They're smaller markets, so it doesn't take obviously as much capital to move them, and I think that's what you're going to end up seeing. That's what I expect to happen this year. And so I would imagine that gold silver ratio is going to contract. Silver will outperform relative to gold, and this is where the platinum story becomes interesting, because if you start to see the white metals pick up, you could see, with regard to platinum, it's a much smaller market. It could have a much more explosive move, I guess, even though maybe the forecast for platinum is, from an industrial standpoint, is maybe not as grown as much. From an investor standpoint, investor capital can basically overrun these smaller metals.
Mm-hmm. It's funny when you were mentioning that let's say the younger generations, if they get gold or silver passed down to them, that they're going to be selling it in favor of other things. Is it something like maybe Trump or Melania coin?
Yeah, that's an interesting one. I don't understand that coin, but yeah, you're right. The younger generation, I think, has been captivated by these moves, which it takes typical asset classes years, if not decades, to do, and you're seeing it done in a matter of hours. That for any generation that hasn't experienced a bear market and seen the downside of those types of things, yes, it's very it lures you in. It certainly it's very sexy. It's like I can get rich quick. I can actually maybe my financial plan is accelerated by years, not or tens of years. I can zoom in now and maybe afford to buy that house or expensive car just by a couple hours of picking the right meme coin. But yeah, that's and that's a difficult thing that we're living in today. I think that actually solidifies the metals a little bit more, is that we're living in a world of speculation and leverage, which tells you a lot about society. And that's the hard part. I think seasoned investors are looking at this and saying, listen, I've seen this rodeo before. I've seen 99, 2000. I've seen the Asian contagion in the 90s when Asian currencies went to hell in a handbasket. We've seen what happened in 2008 when you had over leverage in the real estate markets. This is a very, the crypto market's a very fast moving market that can move on a dime. And it's one of those things that right now it's being pushed now by an administration trying to gain more public acceptance. But you also have very large players, almost, back in the 1920s, you had what they call stock operators that really had influence on a stock or on a market, and they could really paint the tape. And you had ultimately, after the 1929 crash, you had the Securities Acts of 1933 and 1934 to kind of remove that type of manipulation out of the market. Well, you're seeing it come back now, where public companies are borrowing, issuing borrowings of debt or additional stock offerings, diluting existing shareholders to buy these digital assets, because the idea is I can push this price higher, and then they create this, and then you have Wall Street and a lot of these big ETFs that are continually gathering more and more of this capital, and so you have this sort of rush of money coming into a sector that's really hot, and that's sometimes when it comes in that fast, it can also leave just as quickly. And that's we're living at interesting times coming into this presidency. Obviously, I hope that President Trump does some great things and maybe puts into some policies that makes it a much more honest and fair environment out there. But obviously, putting out a meme coin, 2 days or 3 days before his inauguration, it's not the greatest of optics, I guess you could say.
Mm-hmm. So, Bob, do you think that starts to take away a little bit of credibility for the crypto industry?
Yeah, I think, I've been in the business since 92, so I've seen a lot. I've never seen a administration push a particular asset class and actually participate in it at the same time. Typically, when politicians come into public office, they're there to serve, not to be served. And unfortunately, we're living in an age where congressional leaders are making more money trading the markets with potentially insider type information, and certainly their returns are outsizing, the general public's returns. That's not the greatest of optics. It doesn't lend to trust building. It lends into this era of let's just get rich quick. Let's not think about tomorrow. And that's very difficult as a business owner, especially as small and large businesses. They try to gauge what the market's going to be like and what the economy is going to be like 3 months out, 6 months out, 2 years from out, and all they're seeing is this live for today type of moment. It's going to make it very difficult to understand, well, what's demand going to really be like if if financial assets go down, because now financial assets are such a big portion of the wealth effect. And you have household ownership of U.S. stocks at all-time highs. We're all tied to almost the financial markets, which can be kind of crazy because we saw what happened in 1929 when you're taking tips from the shoeshine boy. You were seeing the same type of fever now, and that certainly we could move higher in the stock markets, but the problem is we're all connected by this pool of liquidity and this almost this need for more and more liquidity, this more sort of shots of heroin to keep that same rush going. Eventually, the patient burns out, and that's the thing you have to kind of worry about with the general markets at this moment.
Mm-hmm. Bob, the other day I had a a discussion about the Treasury revaluing the gold that is currently held on the balance sheet. You tweeted out something that was somewhat similar the other day about if you were, let's say, one of Trump's advisors, how you would go about bringing some, let's say, sobriety and restraint back to the U.S. monetary system. How would you go about that?
Yeah, it's interesting because the tariffs, what people may not understand is the the talk of tariffs and the scaring of the markets trying to cover short positions and the market structure is actually causing a flood of metal coming back into the US, because that metal is actually going to satisfy the derivatives and the futures market obligations that players have already put into place. So you have a lot of metal coming into the markets. Now, actually, if you did implement some type of tariff, you could actually adjust the price higher artificially with tariffs, which actually would work toward your favor from a standpoint of saying, hey, listen, the dollar's strong. We don't want to just simply kill the dollar, but but at the same time, we need to inflate somehow, and we need to also balance our balance sheet with the debt that's on our books that may be held by foreigners, so they don't just continually sell debt. We need to create confidence in our U.S. Treasuries as we fiscally spend ourselves into as much as they're spending. Well, if you can actually, the Treasury holds 8,000 tons of gold. It could remonetize that gold, reprice that gold at a higher price. And through the use of tariffs, they could actually artificially increase that price without having to affect just the general inflation rate amongst just normal goods, so to speak. All of a sudden, that revaluation higher in the gold price, you can actually then incorporate, like I mentioned in my post, you could actually bring in the Exchange Stabilization Fund, which was created back in, I believe, the 30s. The Exchange Stabilization Fund is a working operation that actually trades gold, trades foreign currencies, and so forth. But it's there designed to create stabilization within the dollar. But you can use this same situation to actually strengthen the balance sheet of the U.S. Treasury by revaluing gold higher. Therefore, the debts that are held by the public or the debts that are held by foreign investors of U.S. Treasury debt, they could see that, okay, listen, the gold price now, the gold that's held on the U.S. Treasury's balance sheet now covers actually maybe the debt that's held by us as foreign owners. We have a little bit more confidence now that, okay, maybe you're getting your financial books in order, and all you need then is to see spending starting to decrease, and you're starting to see maybe more prudence by the government and by the executive office and the Congress, trying to work together to rebuild this country's fiscal behavior. That would start to loosen up the need to own physical metals as a retail investor, and all of a sudden the metals have been priced higher. So now the retail investor can now sell that metal, for example, invest it in maybe productive assets that are income oriented or other businesses, whatever it may be, and you're starting to reinvest in the country rather than putting your assets into these stores of value that have certainly a lot of positive notions with it, especially when it comes to guarding yourself against purchasing power and devaluation of the dollar or inflationary effects of spending and so forth. Now you can relax a little bit, so the public doesn't need to own as much physical metal. That
after it's already been revalued higher.
Yes, and that will inspire an economy on a positive fashion, and that's how you actually can utilize these tariffs from a positive standpoint. Because at the end of the day, we're all trying to make not just our lives better, but our kids, our grandkids, our future generations. We want them to have a better life than what we've had, and I think this is one way to do this. And I'm hoping that if obviously the Democrats had the opportunity, and I didn't see much. Obviously, they inspired a lot of people to buy more metals. But this is maybe an opportunity that, if from what Trump had campaigned for, which was, to try and put America on a better footing, make it more competitive again. This certainly would be one of those things that could help them make that happen.
Mm-hmm. Did you see more, let's say, more physical buying coming into your business leading up to the election, and has that abated quite significantly? Like what did you see for demand coming into the election when, we were getting the poll results that Harris was doing quite well?
Yeah, it's interesting because I put out a tweet, I think it was over the summer, that there was a study done that actually twice as much precious metals are bought under a Democratic administration than a Republican administration. So, and the idea behind it is, if as a conservative, and you see a liberal that's in office and they're going to spend and so forth, and tax, you're trying to protect your purchasing power. Whereas if a conservative is in power, it's all of a sudden, my guy is in office. I don't need to worry as much because he's going to have my back. And so you don't have to buy as much metal. It's interesting because, that did from the higher net worth investor, the ones that didn't have any metals or maybe had a very, very low allocation. I think as the election kind of led up to into October and so forth, especially from the summer, you started to see people starting to say, okay, I need to get an allocation in this asset class because I just don't have it. I don't have that exposure. Whereas really 2024 was really a sign from retail that as prices were rising, they were actually getting out. They were cashing out. They were, some had been in the markets for a long time. Some of them just bought it, in 2020 to 21, 22, when the markets were down in the low 20s. And they said, listen, this was my equivalent of a money market fund. And the prices have gone up. I'm just going to take profits and move on. So it's the higher prices inspired selling on the retail level, whereas a lot of the high net worth individuals were still buying. And I think that's really the theme that has actually been very consistent really since about 2018-19.
I want to go back to this idea of tariffs and kind of this revaluation of gold. Do you think that if these tariffs do go through, does that ultimately signal to the rest of the world that the US is still happy to use the dollar as a weapon and spurs more central bank buying than just, I don't want to say just, but mostly from China, as we've seen over the past, let's say, 2 years?
Yeah, this gets really complicated because obviously you could go down various rabbit holes, but at the end of the day, if the tariffs are put in place for goods across the board, some may say, well, this is just a blanket tariff, designed to protect the national sovereignty of the U.S. But if you look at, and there's ways obviously for countries to try to kind of reduce that sting by devaluing their currency and so forth, whatever it may be. There's ways to do that. Or basically open up factories here in the U.S. But with this idea with gold and silver, what's interesting is that the U.S. is still a very dominant. They're the dominant player out there in the financial system. You're not really competing. You're not creating a world of a direct competitor of a currency for the dollar when it comes to revaluing gold. What I would suggest is you're using gold. And potentially silver, whatever it may be, but you're using those metals as a way to strengthen the balance sheet, to really support the debt structure and give confidence to public investors, foreign investors, whatever it may be, in treasuries, that we are doing the right thing of trying to try and get our fiscal house in order. I think if you use it from that angle, it's not simply saying, we think the dollar is going to go to zero. I think you're using it from a much different profile than, say, for example, the gold standard back in the 30s, obviously putting the currency on a gold standard would be heavily deflationary. It would be extremely disruptive. And I doubt politicians would ever want to do that. But if you use gold from a standpoint of backing the debt, especially specifically held foreign owned debt or public debt, and you're conveying that idea that, hey, we're working to make this a better place, and reduce our fiscal spending and so forth. I think that takes a much different tinge than the traditional, hey, listen, we're either on a gold standard or we're off a gold standard.
Mm-hmm. Excellent, Bob. Well, I think that's a good place to kind of wrap up for today. I always appreciate you coming on to really update us on these things. I know your Twitter feed is full of research like this that, not everybody is always paying attention to, but it's always worth keeping in mind. Is there anything that you'd like to leave our listeners to think about before we wrap up?
I think that at least right now, obviously tariffs have a huge storyline, I guess, that we still need to kind of understand. But after that, we're still going back to, hey, listen, what is the economy going to do? What is liquidity? What are central banks going to do? What is the fiscal spending going to look like? Those are still dominant themes, I think, that are going to affect us here in 2025. Whether inflation's going to pick up again, or are we going to curtail that spending with the Department of Government Efficiency, I guess you could say. There's obviously a lot of unknowns out there, but I still think this is a year that you're going to see a lot of volatility. I think that could actually help the gold and silver markets from a standpoint of maybe shaking the tree on many of these the stocks that have had tremendous returns. Maybe you start to see and even also the crypto markets, if technology comes into play and, maybe the tokenization of assets becomes a more dominant theme. I've looked at the idea of actually creating a stable coin backed by silver. And so which has kind of far reaching effects, but you start to see that broadening of, now that the regulatory outlook is becoming maybe a little bit clearer, which 2 or 3 years ago it was almost impossible to start some type of stable coin because you just didn't know who was going to actually be a regulator. Was it going to be the states? Was it going to be federal? And then of course, is it going to be under the jurisdiction of the SEC or the CFTC or states in general? And so there's a lot of questions there. But if we're clearing this up, and you make it maybe easier for investors to maybe get involved in the precious metals through tokenization, that could be a huge benefit as well.
Mm-hmm. Excellent. As always, Bob, thank you again for the update. Of course, for those that don't already follow you, all your Twitter feed and the research that we based today's conversation on, all available at Profits Plus ID on Twitter or X, and of course, goldsilvervault.com. Bob, thanks so much for your time today. Always appreciate it.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.